Here's why CD accounts and treasury bills are a lie. Because those returns that they're giving you, 3 to 4%, can't beat what the market can give you in one day. The market can go up 3 to 4% in one day. I understand that you wanted to be in them to protect yourself from the bear market from 2022, but that has now passed and we're in a new year, 2023, and it's time to look ahead. And the market usually returns 7% a year. So 7% beats your 3 to 4% any day. Plus, again, we're off 20% from the highs in the market. If you look at a chart of the SPY, the market has a lot more room to run before we reach old highs, more than 7%. And the market always reaches new highs. It's not like it, has a risk of getting back to the old highs again. It always goes up. Look at that chart. So you buy on the dips, and this is what we're doing. And if you buy treasuries and CDs instead, you're going to lock in that rate, and it's just going to go sideways forever. And you have to hold that till maturity in order to get your principal back. Whereas with the S&P, you could hold that forever as well, but you could make a ton more than 3 or 4%. Now, if you're trying to switch out of the CDs and go back into the market or treasury bills, you can't because they're not liquid. You have to sell for a loss in the open market. So you have to hold them to maturity, or you have to sell for a loss in the open market potentially. And why take that risk? And the third problem with CDs and treasury bills is that you have to put a lot of money behind them to make a difference. We have 400,000 in this account, and we make 97,000 per year. And we're putting all of our money and then some behind it. We're using our margin money and our account value. So we're using 400,000 here to make this 97,000. We're using our 400,000, 97,000 income. And we're also using this 200,000 in debt here on the bottom right to juice more income out of our plays. So we use this margin purchasing power here. Anyway, we have to put a lot of money behind these things in order to make 97,000. So if you're putting a lot of money behind CDs or treasury bills and you're only getting 3 to 4%, you have to put a ton more money in than I'm investing in the market currently. You have to put 20 times that amount just to receive the same income that I'm receiving. Now, if you're not trying to make this level of income and you just want the safe, steady 3 to 4% out of your treasury bills or your CDs, that's fine. But again, the market can beat that. If you need to sell, it's not liquid. And and you have to put all your money behind it to matter. And last but not least, if you do actually have some money to put behind it, like millions of dollars, then you're going to get put into the higher tax bracket of 36% or 37% or whatever it is, which then takes a quarter, of your yearly gain. So if your CD account was 3 or 4% that you're getting, but you have to pay 30-something% in taxes because you put a lot of money in it because you're an affluent person, well, a chunk of that is now gone to taxes. Our investments here are tax-free, many of them. Cornerstone, we see our past wall on Cornerstone. All these videos here, Cornerstone is tax-free, a portion of it is tax-free. AMSA, our pipeline videos, which we just did a huge series on here, part 1, 2, and 3 of why oil and gas jobs are a lie. AMSA pays tax-free dividends, but we didn't put all of our money in AMSA, obviously, because that's a volatile sector, and oil and gas, you can't put your entire portfolio in it. You have to put it in the indexes. So don't put your entire portfolio in CDs or treasuries. Don't put them in oil and gas either, for that matter. Put them in the indexes, which is how we earn a safe 97,000 per year. Thank you.